Hey everybody, welcome back to the channel. My name is Justin, and today in this video, we're looking at my favorite 5 stocks in the market for April 2023. If this is the first video watched of mine, I am a value investor. I follow other super investors that are out there in the value-oriented space like Howard Marks, Warren Buffett. I even took Phil Town's investing course a few years ago and tailor a lot of my strategy on what Phil Town actually talks about in his investing course, and also some of his books, which are actually right behind me here. So let's just dive right into this and talk about the first stock. But before I do that, if you don't mind hitting that like button, and if you like this content, subscribe to the channel. So let's talk about the first stock. All right, so the first stock I want to talk about in this video is Charles Schwab, ticker symbol SCHW. Actually, this is the first time I've talked about this stock on this channel. You can see a 1-year chart right here. You can see this big old dip it's taken over the last couple of weeks. If you know about Charles Schwab, they are in the banking space, and banking stocks in general have been hammered over the last couple of weeks. And out of all the large banks that are out there, Charles Schwab has probably taken the biggest hit, which we'll talk about here more in a second. But as far as a business overview for this company, they are a digital bank. You can actually go online and get a bank account. I have one of those myself with Charles Schwab, but they also are an investment broker as well. And you can actually see their revenue over the last 4 or 5 years has just upticked tremendously, going from 10 billion all the way up to $20 billion. Now, a reason why that they've been taking a bigger hit than the other big banks over the last week or so is that now investors are taking a look at their revenue and their profits, and they're concerned. And there's some validity to those concerns, because about $10 billion of the revenue from last year was in interest on money they got from investors that are investing in the stock market. And of course, this year with the stock market being down, even in the last quarter of last year, or last half of last year specifically, investors are not putting as much money into the market. There's not as much money at Charles Schwab. They can't earn as much interest. So the market in general is concerned about that. I think that short term, but it is a cause of concern in the short term. So now if we go on and we talk about some charts here, so a price to earnings trend for Charles Schwab over the last 10 years, on average, they've actually been around 25 to 26. Right now, they're trading under a 15. And you can see that the lowest they've been as far as a PE goes, you have to go all the way back to March 2020 when the whole market collapsed at that time. So from a PE scenario, it looks cheap. Now, banks in general, I do look at PE, but that shouldn't be everything really for any kind of stock, that is. But it's interesting to see that trend over the last 10 years. Now, as far as intrinsic value for Charles Schwab, now this is what I think they're going to do as far as revenue and operating profit. So I think they're going to grow around 9% on average per year over the next 5 years. Keep in mind they did about 12% over the last several years per year. So a little lower than what they have done previously. Now, as far as operating margins go, as being a broker, they have amazing profits. I think it's going to be around 40% on average. Multiple 17, it gives me an intrinsic share price of $73, which is almost a 30% margin of safety. Now, I think it's a good buy now. I would put it a great buy if it dropped down to $40 overall. Now, second stock I want to talk about is Douglas Emmett, ticker symbol DEI. It is a REIT, which we'll talk about more in a second. This 1-year chart is ugly, down 56% over the past year. All right, like I said before, they are a REIT, so they own property. They mainly focus on Los Angeles and then also Honolulu. You can see their portfolio breakout here is 65% LA West Side, 24% LA Valley, and then 11% in Honolulu. So most of their stuff out in Hawaii is actually homes, which they lease out, and then the properties in LA mainly are office space. Now, REITs in general have been hit really hard over the last year. There's a lot of leases that have come up that have not been renewed. And look at Douglas Emmett specifically, their vacancies are around 20 to 30%. They are about 70% full, but that is historically very, very low for them overall. But I do think eventually they're going to bounce back. But with the economy being bad, that's just where they are right now. As far as the book value per share, this is the lowest they have been in 10 years. They're trading under $1 of book value. On average, they've been at a 2. So just on that basis alone, it looks like they're trading at well below a 50% margin of safety. But if you don't think office space is going to recover going forward, then that is going to be a problem overall. Let's talk about the third stock here, and that is Baxter International, ticker symbol BA. You can see a stock chart over the last year. This is also a very ugly stock chart going down 53%, all the way down to just under $40 here today. Now, Baxter, this is a turnaround play for me. So this is a company that is going through a huge transformation. They've been very active on the acquisition front over the last several years. But what's really interesting, over the last several months, they've actually announced that they are going to actually spin off some of their divisions into independent public companies. For example, like their kidney care division itself. And the company just has really been hit hard, even with their acquisition that they did back in 2021. They made a massive write-off, like $3 billion write-off in the last half of last year, which has just absolutely crushed the stock. Now, this company designs and manufactures medical equipment, which is a high need in general, but they're just on a significantly bad trend, even when you look at their financials. But I do think they're going to recover long term with this turnaround play that they're trying to do overall. Now, as far as intrinsic value for this company, I think they're only going to grow up 4% on the top line over the next 5 years. I think their operating margins are going to be around 18% long term. A multiple of 18 gives me about a share price of $71, which is almost a 50% margin of safety, around a 45% here today. And if you're wondering how to value companies, I do offer on my Patreon templates that give you the ability to calculate the intrinsic value of companies. I offer a couple of different templates on there and even a video that walks you through on how to use those. So if you're interested, I'll put a link down below to the Patreon. You can go check that out if you desire. Now, next company I want to talk about is Ally Financial, ticker symbol ALLY. Stock chart over the last year down 40%. This company is also in the banking space. Now, this company is getting a very bad rap right now. In fact, this whole banking crisis that we've seen over the last couple of weeks, with some of those Silicon Valley banks just actually getting dissolved completely, Ally Financial is getting pulled into that. In fact, I read an article here recently that named the top 10 banks that are going to go bankrupt over the next 2 years, and Ally Financial was one of those, which to me just seems pretty ludicrous overall. If you look at their financials, they're really impressive. In fact, this 20% ROTCE, if you know anything about banks, that is absolutely incredible. That's a return on tangible common equity. Even some of the large banks that are doing extremely well will be around 11, 12, 13% ROTCE. So over 20% is absolutely incredible. Not only that, but one thing you want to look at is deposits. If a company's going to go out of business in general, especially a banking company, if they're not getting deposits, that is extremely worrisome, or people pulling out of their money. And that's just not what's happening with Ally Financial. In fact, you look, $137 billion of retail deposits from 2.7 million customers last year. Now, one thing that people look at or overlook for Ally is that, yes, they do have a large car loan portfolio, but that has been going down year over year as their digital bank segment of their business, which is the #1 digital bank in the entire world, that's going to continue to grow, and that loan portfolio is going to go down. So I don't think Ally Financial should be hit as hard as they had been over the last few weeks. Now, intrinsic value for this company, I think it's only going to grow around 6% per year on the top line. Their operating margins, and this is basically earnings from continued operations. That's how I look at it for banks. I think it's going to be around 22% long term. Low multiple around 8 gives me almost a $40 intrinsic price for them. So it's almost a 35% margin of safety overall for Ally bank. All right. Next one up is SCHW Royalties, ticker symbol STR. So this is the last stock I want to talk about. You can see there's chart is just up and down. Now this company has been going through quite the transformation. So they've acquired a bunch of companies over the last several years, and one in particular, the fourth quarter of 2022, and they actually changed their ticker symbol halfway through the year last year. So there's not a ton of financial information based on what the company is right now. So just keep that in mind. So let's talk a little bit about what this company does. So they manage oil and gas, mineral, and royalty interests in U.S. shale plays with a focus on the Permian Basin. So this is an oil and gas play. So I'm not going towards like a big operator, say like an Occidental or a Chevron or an Exxon. I'm going after a company that has royalty rights, and their margins are absolutely incredible. You're talking well over 95% as far as gross margins go, and then their operating margins are 50% plus, which is just amazing because they don't have to own all this equipment that those big operators do overall. Now, keep in mind that in 2022, they did around 18,000 barrels on average as far as the royalties that they get from. They're projecting in 2023 around 34,000. So it's almost double the amount of production, potentially the double amount of royalties based on how oil and gas does this year. Again, this is just a play long term on where I think oil and gas is going to go overall. Now, as far as a valuation for this company, so I think they're going around 13% on the top line. And this does include their recent acquisition from last year. Now, I think that their operating margins are going to be around 45%. I think actually going to be probably higher than that. I'm just being very, very conservative. In fact, this past year was around 63%. But again, just being conservative. Multiple around 16, which is average for the stock market historically. That gives me an intrinsic share price around $33 for this company. Now, they are paying a massive dividend, over 10% right now, but this will go up and down based on how oil and gas do over time. So if a barrel of oil is $60 plus, I think this company is going to do very, very well. But if oil drops down, say $40 a barrel, well, it's not going to do very well, and this will be not a good investment. So we'll just have to see how it goes long term. All right, so those were the 5 stocks I wanted to talk about for April 2023. I'm curious, do you own any of these stocks? Do any of these stocks look interesting to you right now? Again, if you're interested in my Patreon where I teach you how to value companies and provide actually templates for to use, I'll put a link down in the description below. You also get access to my Discord channel as well. Thank you so much for watching. I really appreciate it. I'll catch you on the other side. Take care and God bless.